What's going on, fellow wealth builders? In today's episode, I'm going to dispel myths around whole life insurance policies. So, the number one thing that I hear when talking with people about whole life is they say that it's too expensive. And when they're saying it's too expensive, I think they're merely viewing it as the difference between how much term cost and how much whole life cost. The problem is what they don't see is the two different utilities behind each financial vessel. So term is straight insurance. That money that you put into that term policy, you're not going to see any of that money. That money's just going to disappear. Where in whole life, on the other hand, will stick with you for your entire life, and when you do pass away, it will pay out 100% guaranteed. And because of that, there's a higher premium. But there's also so many benefits that you get with your whole life policy that you do not get with term insurance. And I'll list those as we go through these other myths. The number two thing that I come across all the time is that it's a poor investment choice. And I 100% agree that it's a poor investment choice because whole life insurance should not be viewed as an investment, because it's not. But what whole life can be viewed as a great foundation to your finances, a great foundation to the financial structure of how your money is put together. It's the foundation. And it's important to build a strong foundation so that you can build a good structure from that. A lot of times we'll hear things like returns are too low. So some of the things that you'll hear on the internet aren't necessarily accurate with what kind of returns you can get with whole life. And it's unfortunate because a whole life policy has a better risk adjusted return than if you were to purchase bonds yourself. So that, and then just the safety and the guaranteed growth that you get behind it makes it that much more attractive, and using your whole life as a savings account. You hear this a lot. Oh, well, whole life is only for wealthy people. And that's really not true at all. Whole life should be utilized as a foundation to basically almost anybody's finances. It's a great emergency fund. It's a great volatility buffer. And by having your whole life policy and then going out investing in the stock market, your finances are going to be in a better position. You're going to be able to weather those ups and downs that much easier because you can access the whole life money whenever you need it and keep your investments rolling even in those down years. And that's why it's so much more powerful to utilize both. It's not an or, it's an and products. You should have both working together in a balance. A lot of people say it's too complex to understand, and it's really not that difficult to understand. So a whole life insurance policy is a contract that guarantees that you will get a death benefit when you die. And within that contract, you have a cash value aspect, and that's the money that grows uninterrupted compound interest that has a better risk-adjusted return than bonds. And so that money is your accessible cash, and that grows as you pay for premiums and as those paid up additions and as your dividends pay every single year, it just continues to grow. And then you have the death benefit side. So as your cash value grows, as does your death benefit. So we hear this a lot. Money is locked up and inaccessible. That's not true. The mutually participating whole life insurance companies that we use, your money is accessible. You have, it takes 2 to 3 days to receive a check from when you want to take out a policy loan. You can also take out a withdrawal, but you lose all the benefits when you do that of the compound uninterrupted interest. So the money is very liquid, very accessible. It's a great place to have an opportunity fund. It's a great place to have a volatility buffer. One of the other things that I hear a lot is that it's not flexible. And if you traditionally design that policy, they're correct. It's not flexible. Let's say that you had a $500 a month premium, right? You would have to pay that $500 a month with your base if it was 100% base. However, the way that I design policies and the way that I recommend agents design policies, for the most part, is to weight it more towards PUAs, which are paid up additions. So maybe a 30% base and a 70% PUA. What that means is the minimum you would have to pay is 30% to keep that policy in force. But however, the maximum that you could pay is that 100% or the full $500 a month. So knowing that flexibility is baked in will make sure and allow you to have that policy work for you for your entire life. So you can weather when you have maybe some cash flow issues and you're not able to make those payments. And then we hear this all the time, buy term and invest the difference. And that's just such an interesting concept. I don't really resonate with that concept at all. Most people will buy term and they won't invest the difference. And then when it gets time for their retirement, they're screwed and their family is left with a huge gap. And we don't want that to happen. So what I would say is buy a whole life and invest. Have both working together, working as two amazing economic powers, the actuarial science of whole life and the compounding interest of a higher risk money in the market, in the stock market. So use both, and the financial structure will actually be able to weather any economic storm, because you have, if you're, let's say that your high risk accounts took a 50% hit like they did in 2008, 2009. If you had that whole life policy in place as your foundation and you saw that your accounts took that hit, you would know that you could weather that storm. But if all your money is tied up in your 401k and you start having to withdraw it, you're greatly damaging the how much money you're going to make with those types of investments. So really, it's just a much more strategic way to build your finances when you have your whole life and you invest that money at the same time. So if you found this video to be helpful, be sure to give a like and a follow. And if you're kind of interested in learning more, feel free to schedule a discovery call in the link below.